Imagine you have a big financial responsibility due, but the date seems a little off. Perhaps you are wondering if you have correctly understood the timeline for your tax obligations. Yes, the January 15 estimated tax payment is indeed for the previous tax year. It is the fourth and final quarterly payment that covers your income earned from September 1st through December 31st of the prior year. The United States tax system operates on a pay-as-you-go basis. This means you are expected to pay most of your tax liability throughout the year as you earn income, rather than waiting until the April 15th tax deadline. For many people, especially those who are employed by a company, this happens automatically through payroll withholding. However, if you are self-employed, a gig worker, or have significant income from investments, rents, or other sources where taxes are not withheld, the Internal Revenue Service expects you to make estimated tax payments. These payments are typically due 4 times a year to cover your tax obligations. The January 15 payment specifically covers the income earned in the last 3 months of the previous calendar year. So, while it happens in the new year, it is definitely settling up for the old one. To figure out if you need to make estimated payments or how much to pay, you will need to estimate your total income and deductions for the upcoming year. The Internal Revenue Service Form 1040 ES, Estimated Tax for Individuals, includes worksheets to help you calculate your expected tax. If you realize you missed an estimated payment, it is best to pay it as soon as possible. Paying late could result in penalties, but catching up quickly can help reduce those. It is always wise to keep good records of all your income and expenses throughout the year. Understanding this quarterly schedule is key to avoiding an underpayment penalty, which can apply if you do not pay enough tax throughout the year through withholding and estimated payments. The Internal Revenue Service has what are called safe harbor rules. These generally state that you can avoid a penalty if you pay at least 90% of your current year's tax liability, or 100% of your prior year's tax liability, whichever is smaller. For higher income taxpayers, this prior year percentage can be 110%. Knowing these rules can save you money and stress. So, while it might feel counterintuitive to be making a payment in January for a year that just ended, this final estimated tax payment is a crucial part of fulfilling your pay-as-you-go tax responsibility. By diligently estimating your income and making these for quarterly payments, you are effectively managing your tax burden throughout the year, preventing surprises, and staying compliant with Internal Revenue Service requirements. It is all about planning ahead to ensure a smoother tax experience.